Hello and welcome everybody. My name is Ethan Tran and welcome to the Realtor Roast, where we break down real estate myths and brew up smart solutions. Today I'm joined by Mr. Kelly Chau. Say hi to that, everybody.
Hi, Kelly. Thanks for having me.
Of course, anytime. Thank you for coming on. If you could give us a little bit background about yourself, about who you are, what you do.
Sure. So my company is called ACG Funding. We are a local direct lender based out of LA County. We've been around for over 25 years now, and we really specialize in the local market, providing tailored solutions to the real estate around this area. And we work with really bright, the best of the agents in this area, like yourself, Ethan.
Awesome.
Yeah.
Thank you. I appreciate that. And for those of you guys who don't know, my name is Ethan Tran. I'm a realtor in the Southern California area. I'm currently with eXp Realty. So let's dive straight into it, okay?
Sure.
You know, a lot has happened in the real estate market this entire, past few months. Just these 3 months, there's so much that's happened.
Yeah.
And I want to break that down with you because a lot of it is about financials, a lot of it is about realtors. Mm-hmm. Let's go over what's currently happening, what everyone has on their mind. Mm-hmm. Let's talk about the interest rates.
Interest rates, of course. And I can't tell you about how many calls I get a day about the 50 basis points cut that everyone's, been discussing about, and whether or not how that applies directly to the mortgage market. Now, a lot of people have the misconception thinking, 50 basis points cut means, interest rates should fall by at least 0.5 or 50 basis points, right?
Yeah.
Which is what I try to really clarify with people that, it's the Fed funds rate, which is what the Fed is actually cutting, does have correlation with the mortgage rate, but it's not directly correlated, right? So with a lot of the recent rate drops that you saw starting early September, that's actually the market reacting to the news of the Feds announcing this and the likelihood they were going to cut rates. So the current market where you're sitting, we're seeing the average 30-year fix right around the 6% mark with your normal scenario. That's already pretty much baked in with the Fed's decision to cut rates. Mm-hmm. So we do expect rates to gradually decline, but not instantaneously, like what some people might think.
Okay. So let's say like right now. So right now we're within the first few weeks of October. Mm-hmm. Do you think when it comes to like people, let's say they were waiting for the rates to drop, right? Do you think now or sometime soon would be the best time to, actually start making that move for them?
Right. Well, Ethan, that's a great question, because if I had the crystal ball of seeing where market rates are actually going, they're pretty much same. Likewise, you're asking, what's the stock price of Tesla towards the end of the year, or where it's going to be. No one knows for certain where that exactly the rate will be at least in the short run, but in the long term, we know the Fed, and if you look at what they call the dot plot. Now, this dot plot is where they actually show you the Fed's decision on when they're actually cutting rates. So we know that the rate cuts are going to be gradual, but they can always change their decision, right? Based on economic factors, indicators. Is inflation still there? Is it still persistently a problem? The health of the economy, right? Is if they see jobs reports with more unemployed people, that's a sign of a bad economy, which would cause the Feds to want to push rates down to kind of stimulate, right? So there's a multitude of factors that affect it, but more importantly, I would say right now is actually the best time you want to enter. The reason is that you always want to stay ahead of the trend. I don't know if you saw back in when COVID first started, when rates moved to record lows, you can see there was a huge influx of buyers, right? And a lot of competition. We saw, price wars, bidding wars, driving prices. I did a lot of deals where my clients were getting outbid by 50,000, 100,000 over asking, right?
Yeah.
So whenever rates drop, it does encourage, a flood of the buyers who have been sitting out because of the high rates. They want to get involved. Right, so we always suggest if you have the capacity and you are able to move forward, we always suggest doing it now than later, especially taking advantage that rates have recently dropped.
Yeah,
so.
I want to go over a bunch of stuff today. We have a lot of questions that we've prepared from this. You've had a lot of clients ask you a bunch of questions that I'm sure some of them you're kind of sick of receiving. I've received a bunch of questions that as much as I want to explain to them everything, I don't feel like I have it in me to spend 2-3 hours every person to explain it to them, right?
Sure.
You wrote a few questions here. We just talked about, the fact that mortgage rates aren't necessarily directly affected by interest rate cuts, right?
Well, they are correlated, but not directly. Right?
Yeah. Okay. So what you're saying is that people should just, take the jump right now because they know that it's going to happen eventually.
Right. There's a few factors that go into that, right? Most importantly, I would say, like I said, right now we're already seeing, with the rates already being in the higher end of the range historically, we already see a good amount of buyer competition. Not necessarily because there's already a flood of buyers, but because of inventory, right? So I would say as rates continue to gradually drop, let's say down to 5.5 range to 5 range, the amount of buyers who are actually qualified now come in will increase more and more as the rates gradually decline.
Yeah.
So that means increased competition. That means more and more bidding wars. A lot of people coming in over asking price and limited inventory, right? Which makes it that much more difficult. So that's why I teach my clients, my buyers, hey, if you have the capacity to do so and you're ready to do so, you should, rather now than later. It's almost like opportunity costs, right?
Yeah.
The more you wait, the more expensive things get. And no one knows for sure where rates are going to be. I always preach, what they say, which is marry the home, date the rate, right? You can always refinance, you can get creative. You have a lot of options later on. You won't be locked into this payment for 30 years.
Yeah, exactly. And I always tell that to my clients, there's pros and cons in high interest rate markets. And then there's the same thing for low interest rate markets. I think sometimes people kind of just have to see it from a bigger point of perspective, right?
Right, exactly.
Yes, your rate will be lower, but not necessarily will that mean your payments would have been lower from what you were going to buy if it was in a high interest rate market. It's all based on situation.
Exactly, and for most first-time buyers, they're obviously buying a primary residence. They're not buying investment. A lot of people make the mistake of absolutely trying to nail, get the hammer on the head with making sure it's a great investment decision.
Yeah.
Whereas I preach that a primary residence is a lifestyle choice.
Yeah.
Right? It should be close to schools you want if you have kids. It should, have the backyard that you want if you have dogs, right? You shouldn't be primarily focused on how much return, how much appreciation you can get, if you were to lease it out even. Those are kind of more on a secondary, priority in terms of what you should be prioritizing on what you really want. On top of that, after you buy the primary, when you start to build your real estate portfolio with the investment side, that's when you want to be analytical. But I would always preach that your first primary should always be suited for you in a lifestyle manner, right?
So we already understand that people who are like a lot more emotionally invested into a house are probably going to 100% get that house.
Yeah.
Yes. Let's talk about the people who are, let's say, a little bit more withheld. They feel like they're in a position where they're close to getting it, but something's holding them back, right? What do you say to those people who say, like, they have higher income, but they still don't feel like they should be buying? Do you think it's a better financial decision to be going that route?
Well, that's honestly a great question, and that's exactly why I like to position myself as a loan consultant and not just a loan officer, right? Whereas we kind of take a look at, the reasons. Let's say someone might be on the border of, I want to make this jump, I want to buy a home, but at the same time, I'm worried of overextending. I'm sure you've heard of the term, I think it's called home locked or house poor.
Yeah, where you move in and you have nothing but cardboard and a piece of paper on the floor.
You can't afford furniture, you can't afford to buy anything else, you have barely making the payments.
Paper plates, and a Costco rotisserie chicken there for dinner.
Right.
Yeah.
So of course, everyone's lifestyle is different, so there's no magic equation. However, with mortgage, how it works is all we're concerned about is your debt to income ratio. Essentially what we do is we'll take your qualifying income based on whatever, if you're, you know, you have a salary or you have self-employed and you have a company, we'll calculate that for you. We'll also calculate your monthly debt. Now, the debt will include the minimum obligations for the home, including the mortgage, the insurance, property tax, and HOA. In addition, we also add any of your current debts. So if you have any car loans, student loans, credit card, you know, things like that will be added all together on a monthly basis. We divide that by your qualifying monthly income. And so long as your debt doesn't exceed 50% of your income, you can qualify for that loan. Now, is that always the best choice just because you can qualify? I would say no. The reason is, for example, the system for mortgage, at least, it heavily favors wage earners. The reason why I say this is because when we qualify wage earners, we're taking pre-tax income, meaning the gross amount that you earn that's showing on the pay stub prior to deductions for Social Security, for income tax, and other things. When in reality, that's actually not the amount of money that you receive deposited into your bank account. So you don't want to overextend. That is very true. You want to make sure you have a healthy margin left over for your lifestyle. There's clients I have who stay home. They like to do more so on, you know, on like less expensive cooking. Lifestyle. And we have clients who go out every weekend, who like buying nice things. So it's really according to your own lifestyle. But I always recommend people not to overextend, especially on your first home. So those are very important choices that I can definitely help you assess and make something work for you, right? For example, if you feel like your budget's really tight on buying your first home, but you're single, a lot of times I would advise, hey, I know you might be stretching on the payment, but what if you rent out the other rooms in the same primary residence that you're gonna buy? Now, let's say your payment for a mortgage is $3,000 a month. If you rent out 2 rooms at, I don't know, $800, $1,000 per month, guess what? You're only responsible for maybe $1,000 per month out of that $3,000 of your mortgage. So it becomes a lot more affordable, right? So you can get creative, and there's a lot of ways to kind of help you manage that. Right.
I've talked about this before, you know, like a lot of times whenever people are looking at housing prices, you know, a lot of the times they go like, oh, I can't afford this. But then I feel like a lot of people don't remember it, but like, you know, people get married too, you know, like there's an opportunity to have a second person on that loan and just not have it be you. You don't always have to take it on alone. And I think that's something that sometimes people miss. You know, they're like, oh, I really want to buy a house. Can't afford it. Where are my options now? And let's talk a little bit more about that because you mentioned earlier about your general clientele. Can you say that again for like the audience so then they kind of understand who like, you know, where the assets lie.
So like I said, it really depends on each person, but usually the general consensus and general idea is that the people who are in, you know, buying their first home and those type of people who, you know, are kind of just breaking into real estate, I always tell them to kind of make sure you budget accordingly, right? Like I said, with their asset wise, they'll probably have, you know, a lot of stock accounts, cash in bank, maybe even possibly some crypto or things like that. Otherwise, but they don't really have too much flexibility outside of that, right? Whereas on the other end of the spectrum, we have our advanced investors. They have a lot of different properties, different types of properties, different asset classes. That's where I actually can help them. They have a lot more options because if, let's say, I've had this investor client who came back to me. I've done over 10 deals with him. And I've been successfully able to help him never buy additional properties without pulling additional cash out of his account. How is that possible? Because each time I'll help him assess the equity of each home. And let's say once he identifies a new investment property that he wants to buy, I can actually help him cash out of the equity from another home, take that amount, place it as down payment for the next one, and guess what? I also get him the purchase loan mortgage for that property. So essentially, you can get away with not spending extra cash. And as time progresses, as equity grows in those properties, it's something that you can rinse and repeat
Cash
over
out,
and
yeah.
over. And that's why so many real estate investors have huge portfolios, right?
Yeah.
So, yeah.
All right, so let's talk about, how some common questions that you've gotten from your clients. You wrote a few down here.
Yeah.
And this is for some other people out there to know. So first question you wrote down was, we already went over the mortgage rates. Second one is, what fees are actually negotiable in a transaction?
That is by far one of the most gray area topics, I would say, that I'm asked frequently, right?
Yeah.
Essentially, how the system works is typically what I see is, unfortunately, the title and escrow fees are pretty much almost set in stone. Of course, if you have a special relationship with the escrow officer, or someone that works with them, they can give you a special discount.
Pull some strings, yeah.
But you can actually ask them for like it's similar to like a fees worksheet, where based on your purchase price, based on your loan amount, they have a set tier of flat fees that they charge, and these are not too negotiable in a transaction, right? On the other side, lenders, yes, they're very negotiable. The reason is that with the lender fees, those might be set in stone in terms of what the company charges, but the loan officer can actually structure it to meet each person's goals. For example, let's say for a client that is on the borderline of not having enough cash, right, to close on their home for down payment and closing costs. Sometimes what I can do is, let's say I'll advise the client, hey, instead of taking that 6% where you get, you're not paying points and you're not getting any credit, you can opt for, let's say, 6.25 or 6.375, which you might think, why would someone on earth take a higher rate?
Yeah.
The reason is that the lender can actually give you what we call lender credit. Now, lender credit is proportionate to, let's say, in rate tiers, the higher the rate, the more credit the lender can give you, because the higher the note would sell on the secondary market.
Yeah.
Right? So let's say if you're short by a few $1,000s, or even want help covering the closing costs, it's actually possible by us. You exchange, let's say, get a slightly higher rate. In exchange, you get $10,000 to pay for closing costs, right?
Yeah.
Which is, you might think, not that great of an idea. But generally speaking, most mortgages only require you to make 6 months payments before you're eligible to refinance without penalty.
Yeah, this would actually be really great because, now that you mentioned, covering closing costs, I know there's a lot of buyers out there after the whole NAR settlement and everything. Now buyers have to pay,
exactly,
the realtor stuff. And, now in a sense they think that like, oh my God, now buying a house just got more expensive for us.
Right. And the funny thing is, I just had another case where that was one of the issues. Now,
tell us about that.
They were kind of negotiating, especially on the buyer's agent commissions. One of the agents actually were kind of having a back and forth with the client, right? Everyone's still new to this. It's a new policy that just went into act this year, right? So the agent came to me and said, hey, listen, the client really does not want to pay my commissions. They're very short on cash, they're in a crunch right now. What can we do to, I don't want at the same time to upset the client. So what we agreed on is exactly what I just mentioned, which is take a slightly higher rate. That additional amount, the lender credit, can actually be used for buyer's agent commissions.
Yeah,
so
and there's been a lot of like talk about how this is gonna happen.
Right.
Especially lenders and realtors. We have to work very closely in order to make sure that buyers. The truth of the matter is that the price of buying didn't increase.
Right.
It's just. There's a little bit more paperwork. There's a little bit more negotiation that has to go on. But there's so many other options out there for other people. If you can always bake the commissions into the price. You can still negotiate with the listing agent in order to pay that commission too. I'm sure sellers wouldn't mind too much often if you said, hey, you need to sell your house, give us the commission, just pay up.
Yep.
There's a lot to work around it, and I don't want and I think the biggest thing that's happening is that it might be scaring some people off just the way that people have worded it. But it's good that you say you've gone through a transaction already where You know,
Right,
you pretty
that
much went
was-
through you went through a realtor's nightmare where you know they're juggling their commission,
Right,
but they already made the sale.
Right, which is another reason why having a good loan officer and realtor pair is so important.
Yeah.
Right, because we work together hand in hand as a team to kind of, you know, make sure we provide the best service and also keep the client as happy as possible and making sure, you know, all parties are involved. Now, if the realtor didn't have this relationship with the loan officer might be very hesitant or is tell you, hey, that's not something that, you know, I'm comfortable with. You know, I absolutely have to protect the client by giving them the best rate. I don't think it's appropriate for me to raise them to hurt their terms
100%.
in order to pay your commissions, right? So having a team, you know, that's very fluid is really important in that sense, right?
Yeah, like I completely agree. Having a realtor, especially sometimes, you know, I'm not against working with, you know, if you want to work with your personal friend, you know, your lender or whatever, and then pair up with another realtor. I'm not against that, but I've definitely had bad experiences with that where it's like, you know, I don't know this person's situation, you know, I'm trying to call them, they're not picking up. You know, but when I'm working with people that I do know, it's way easier. You just pick up the phone and it's like, I know you're at home, dude. I know what you do. I know you're not busy. You know, and it makes it so much easier. It makes it way easier for the transaction to happen. I want to build off of what you just said, where it was paying points in order to, you know, adjust certain fees.
Right.
Do you really think that, you know, out of most other situations, do you think it's worth it to start paying points in order to lower your rate?
Right. That's honestly another great question, right? I think most people overlook the context of looking at where we currently are. And I am talking about the market and the direction we're headed, right? With the Feds announcing that with the continuous rate cuts, I do expect the rate range for your average 30-year fixed scenario to, by the end of the year, or generally speaking in Q1 of next year, they should start to teeter down to mid fives. I would say even possibly low fives by Q2 of next year. So if you know that, essentially if you're paying points right now, let's say, you know, your initial offer from the lender was 6% with no points, or 5.75 with half a point.
Yeah.
Right? If you calculate that savings based on your loan amount, you know, that 0.25% savings you get for paying, let's say, 0.5% of your loan amount, which is thousands of dollars, sometimes does not make sense, especially in this market. Why? Because if the rate does continue to drop, and let's say the market rate moves from 6% to 5.5% by Q2 of next year.
Yeah.
Right? By that time, you probably only have made about 5-6 months worth of payments, which are, you know, for 0.25%, I would say on average, you're only saving maybe $60 to $80 a month.
Yeah.
You're not going to recuperate that cost of you paying extra up front.
Yeah.
So what I'm advising to all my clients right now is do not pay the points. The reason is that we're setting you up to refinance and really bring your rate down once the market shifts downwards, rather than have you pay up front.
So I think that based off of what you said is like the people who bought pretty recently, like let's say they've lived in their house, you know, they're fully moved in. It's about, let's say, even 6 months ago or 3 months ago. Now would probably be around the best time to start getting ready to get refinanced, right?
Right.
So that's gonna, you know, start lowering down the payments. It is the time for everybody to, you know, get in touch with your mortgage mortgage officer.
Yes.
So let's go over some other common questions. I want to understand. So, you know, we've talked a little bit about your company already. You guys don't only just do, you know, mortgages. You guys also do private lending, hard money loans, etc.
Right.
Let's talk a little bit about the differences in mortgage rates between companies, because I know that's a big thing.
Yeah.
How does that happen, and what do you think is like the scenario and where buyers could look into?
Right. So, you know, as all realtors suggest, you always definitely should consider options. It's not good to just go to your trusted Chase bank and trust them that they'll give you the best deal, regardless if you're a Chase private client or have some relationship. Right? The reason is that there's a multitude of different mortgage products in the market. Not only are there different products, even lenders who are selling the same product, let's say a conventional loan, they might have, if you call them on the same day, tell them your scenario, ask for a quote, I'm willing to bet 95% of the time, they're gonna give you two completely separate quotes, right? The reason for that is larger institutions work with higher costs, higher expenses. They need that extra margin to pay for all of those, right? Whereas, smaller mortgage brokers, sometimes they will have way sharper pricing, even if it's for the same exact conventional loan, because they're able to really minimize the margin that they have to charge. Now, mortgage loan officers, of course, are not just paid by points. Most people think that, for a loan officer, their commissions are based off of the loan, which is true, but it's not transparent. It's not visible.
So how would you? Because I don't know neither. I don't know neither. Everybody knows how a realtor is paid. Everyone gets pissed off how a realtor is paid.
Right.
How does a lender get paid?
So lender, essentially, what we're doing is, of course, I'm talking about your Govy loans, right?
Yeah.
Your conforming VA, FHA, jumbos. What we do is, once we fund your loan, we will actually sell your loan to a servicer. Now, based off of whenever the loan officer locks your mortgage rate, we'll know on the back end how much that rate is paying. And most loan officers will actually operate off what we call lender paid set compensation, meaning we're taking the same margin on every client and we will bake that into the pricing of the rate, and that will be the actual rate that we quote you. So our compensation is actually paid on the sale of the loan to the servicer.
Okay.
And instead of charging up front. Now, this is not true for all loans. A lot of times, a loan officer can actually lower the base rate we're giving you by eliminating that back end margin. But what that means is that we actually have to charge points, which is where you'll see a lot of times the loan officer will offer you a lower rate in exchange for they have to charge
because
points.
then it covers the commission.
That's correct.
So very situationally, like let's say sometimes, let's say your lender's upfront with you, hey, I want to give you a lower rate, but I need my commission. Those are the times that, paying the points for a lower rate might actually,
I might be spilling too many beans here. I don't want to, upset the industry or any other loan officers out there.
It's up to you. Go ahead.
But yeah, that's generally speaking the truth, right? Which is, that's why negotiating with the lender is always possible. You should never believe that the loan officer cannot budge whatsoever, because even if their compensation is set and the rate they give you is set, they can still actually adjust the credit. They can actually offer you lender credit. And what that does is it can help you offset your fees and costs that you're paying elsewhere, right? Of course, us as lenders, we really care about getting the deal done, right? Which is why we can always customize the rate, the amount of credit, the amount of points we charge. That's always customizable, right? So that's the reason why you'll see a lot of negotiating only done on the loan officer side. Right. Agent commissions are very visible. They're
I mean, there's a lot that happens there too. Like we have a lot of negotiating going on in back. By the way, if you have any questions for me too, I'm sure you have some questions too. Like, I want to give you a chance to get some water breaks every now and then. I feel like I've gotten in 5, you've gotten like 0, but you've talked way more.
You're doing.
But yeah, I mean, like for all commissions, I think is something good that people, especially buyers, they need to take into account is most of them are negotiable, even for a realtor. Realtors a little bit like harder, just in the sense that we do hold ourselves to a higher credibility,
and it's more transparent.
It's more transparent. You know what you're getting into before you get in. But it is negotiable. I feel like for the right reasons. Let's say like hey, I already know I want to buy this house. You don't have to do any work. Just send in this. I'm sure you'll find a realtor who do good work for you and cut the commission a little bit.
It's always kind of like grass is greener on the other side situation, right?
Yeah, it depends.
In my position, because my clients will continually to negotiate, continually to ask me, hey, did rates drop again? Can we still cut things here and there? Whereas, once you're agreed upon, you guys are set, right? Versus us, I'm sure a lot of, especially recently, with shopping and a lot of clients will come to me and tell me, hey, you're the third guy I'm talking to, or you're the fourth guy I'm talking to. What's the best you can offer me?
Yeah.
And they kind of play this game where
Does
they
that
get
piss you off sometimes?
loan estimates from each one. They take mine, they show it to the other guy beats me.
Does that piss you off sometimes?
Surprisingly not.
Really?
It's a little frustrating depending on, if they do it a few times, fine. I'm always willing and always welcome. I pride myself on being really good at being competitive and making sure my terms are sharp. That's really our specialty. But if they take my deal and they go back and forth 3, 4, 5 times, I'm just, there has to be a reasonable level.
There's a threshold where that they're not willing to work with you unless you're willing to get there.
Right.
And then
plus,
you don't want to come out at a loss.
A person like that, they're going to scratch and claw down the entire process. Everything they can, they will, right? Which is the question of, are you willing to work with a client who is going to cause you to get gray hairs and pull your hair out? Because it has to also make sense, right? We all have to make a living. We all have to be fair. The amount of work we put in, especially a lot of consumers, they don't actually see a lot of the back end items, right? For example, like loan approval, getting all conditions in. There's a lot of conditions we issue to the client, but that's probably usually only about a third of them. The rest that we have to work with title, escrow, appraisal, verification of employment forms, condo certs, condo questionnaires. They all have to, every single item has to be checked off. If you miss one item or one item that's not conforming to, the rule set of the mortgage product, guess what?
It could set everything off.
You won't get loan approval or period to close. You won't be able to remove that contingency. Right.
So let's break down on that a little bit then. Because we talked about mortgage so much. I want to. We've talked about also providing so much more help for people who who do need it. Like let's talk about the people who don't know whether they can or can't afford. Maybe they just don't know the right places to ask. They don't have the right resources. Let's say bare minimum. Okay. I get this example a lot. We get 100,000. We get people who make a little bit over 100,000, maybe close to 100,000, and they don't know whether they can afford a home right now. What is your take on that?
Well, generally speaking, I use a rule of thumb. What is that? Assuming, of course, that for this particular person, that there's no major debt, no huge car payments, no huge student loans. But let's say an average example of someone making 100,000 per year, right? Assuming they don't have any other debt, rather just than regular credit cards, and they put 20% down. They can usually qualify for something in, I would say, high 500 to low 600,000 range on the purchase price. Of course, that's assuming they put 20% down. The rule of thumb, is that let's say someone makes 100,000 salary W-2 wise. You take that 100,000, multiply that by 5. Essentially, that's usually right around where they can maximum qualify on a 30-year term for a mortgage, of course, based on current rates. So someone who's making 100,000 a year right now could potentially qualify for up to 500,000 loan amount. You add that 20% down payment, that's about 625,000 purchase price, right? So,
but would you say that's like their only option? Let's say someone makes 100,000, they want to grow, let's say, a real estate portfolio.
Right.
They want to, or like get a much bigger house. Let's put it in like very simple terms. Is that their only option?
Oh, definitely not. Definitely not.
So let's rule a smart strategy right now. We make 100,000. What is your first steps that you're gonna do in order to put yourself in not a $500,000 home, but let's say as soon as possible put you in a $1 million or even $2 million home?
Yeah, of course. That tells me that person definitely has more capacity, right? Someone who is legitimately making $100,000 a year should definitely not be buying $2 million home, right? Let's be real. But let's say, for example, in the case that they're a business owner, right? And they have super high expenses last year. Maybe they had to order extra inventory that didn't sell, or something happened where, their net profit showing on their taxes was only 100,000, right? Of course, we know they have more assets elsewhere. We know they can afford the home. It's just on paper, it doesn't look good, right? Which is exactly what our pre-approval process involves, right? We first take a look at what we call full document, where we try to qualify using taxes, pay stubs, W-2s, and everything. If we determine that the client can't qualify that route with their current situation, then we go venture to something called non-QM, or non-qualified mortgage. Now, this in our industry, the non-qualified mortgage side has grown tremendously.
Oh yeah.
I'm talking,
especially around our area
Right.
too. It's crazy. It's
right. I would say the biggest reason is also because of what happened to interest rates, right? As interest rates skyrocketed, a lot of people that could qualify no longer do, right? So we're dealing with a lot of people who are sitting in this situation where they can't qualify traditionally, through full document, right? So in someone's situation, for example, I just had a client came to me, right? We started the process. I took a look at his year's taxes. I qualified him, and I told him, hey, listen, currently with your taxes, the maximum I can get you is about $700,000 loan amount.
And that's great.
Yes.
That's way better than 500.
But he told me I'm eyeing this property that's 1.8 million. And I said, okay.
That's a jump.
Right, because he was a business owner. Of course he had, not the prettiest year. That's just how his taxes were filed, right?
So what happened with him?
So I took his case, right? And then what we did is we switched him from the full document qualification process to what we call a bank statement loan. Now, how a bank statement loan is that instead of your taxes being used as your income qualifying, standard, we then take 12 months trailing business bank statements from that person, and we take the gross deposits that they're putting in the bank, right? We apply something called the expense factor, usually right around 50%. So 50% of his gross deposits going to his business account, we then turn that into his monthly income.
Oh.
So traditionally, the full document, we were only able to give him like $150,000 annually income qualifying. With the bank statement route, because he owned, a product business, he brought in, I would say $800,000 a month in revenue.
Yeah.
I then increased his maximum loan amount to $2.5 million.
Okay.
So it went from $700,000 to $2.5 million.
Yeah.
Right, which is a complete jump. Right.
And did he end up getting the house?
Yes, of course.
Beautiful.
And the beauty of that is that the difference in, let's say, your bank statement loan versus your full document loan, the spread was only about, I would say, 3/8 to 0.5% higher for the bank statement loan. So it wasn't like he had to, pay a pretty penny, at 8-9% for this loan.
Yeah.
Whereas, it was very close to the rate he would got if he qualified full document. So,
really?
Yes.
That's great. Yeah. So no matter how much people make, there is always some kind of glimmer of hope.
Right.
They just have to know the right people.
Right. So that's why we stress, loan structure is everything, right? Having a loan officer that really understands how to navigate, how to structure your loan, how to absolutely get you the best terms is so important.
100%.
Right.
We mentioned a lot about the ideal client, right? This guy has this X amount of income, but he has good credit, etc. What about someone who has, let's say, very bad credit, high debt to income?
Right.
This person has so much debt. They have a $100,000 car that they're trying to pay off, and let's say they're in that position.
Right.
But now they're also, I want to settle down. I want to buy a house. What are some resources that they have?
Right.
Like, let's say they don't qualify. Like, what are some resources that they have besides, just what ACG offers?
Right.
What connections do you guys have in order to help them get to that position?
Right. So, Ethan, there's always risk in lending, right? And
100%.
lending is always risk-based, meaning our pricing, our terms, our rates are always based on the risk profile of the client, right? What I tell people is that you can't have bad everything, right? You can't have no income, you can't have bad credit, you can't have no assets, right? But what you can have is, compensating factors. What I mean is someone who has a terrible FICO score but has good income, right? That's definitely doable.
Yeah.
Or how about someone that has no income but a good FICO and good assets, right? That's actually very common and very doable as well, right? It's based on which loan product we fit each person. We're almost acting like a tailor, right? Where based on where your circumstances are, will actually fit you and tailor you into the most competitive product we can get you, right? Qualify for. So someone who has bad FICO, I typically, if they can qualify full doc, if they have healthy income, I would suggest them to go FHA, right? Because FHA is forgiving on bad FICO, right? And they can also do low down payment. So FHA shines when those two conditions are true. The client has low down payment and also low FICO, right? On the opposite side, let's say someone who switched jobs or something happened, they maybe left the country for a year, they came back, didn't work, right? Of course, we look at 2-year history for your employment. Even if you have no job, we can still do your loan. How? We have programs called asset utilization, where it's based on your current assets. So long as you have 35% down, guess what? We can get you the loan.
That's great. So let's say they did have bad credit, do you guys have resources and where they can get that repaired? Like, so you do have credit repair, and even like, let's say they're not like, the smartest with their finances, as like as what you like to consider not mortgage loan officers, your loan consultants, would you also be helping people like manage their finances in order to get them into a position?
Well, there's a very fine line, right? There's a distinction, right? Because ultimately our forte is going to be mortgage, and everything we live and breathe mortgage. But of course, your other financial profile is affected, right? So we work hand in hand with credit repair agencies, where I've had countless clients that, let's say they missed the minimum FICO score for a certain program. I'll actually send them to credit repair agency. We work hand in hand, and they're able to basically tell me what the turn time is, how long it'll take, the chances of deletion. Maybe they had a judgment, maybe they had a bankruptcy, something detrimental to their credit. They'll actually be able to advise us on the likelihood of them maybe even removing it completely from their credit, or let's say the time it will take for them to boost their score to where we need it, right? So because we work hand in hand with them, we'll pretty much make sure we have the right expectations for the client. We'll give them the timeline here, this is what you need to prepare. And by the time we get there, we'll make sure that you're eligible and qualified to proceed, right? So there's a lot of steps that I always tell people, don't look at the home first and then get pre-approved for it.
100% no. I hate that.
Chances are there's going to be something that will take time or that you have to give some attention to before you're ready.
The worst thing you can ever say to a realtor is when we say, hey, I want you to get pre-approved, they're like, let's hold off on that. Immediately, I'm like, okay. Something's wrong,
I mean, at least unless they show you $5 million in cash in their account, then sure.
I mean, but like even then, it's like they're like, oh, I want to finance, and then I'm like, all right, let's talk to my lender. Let's not talk to I get it. It's a little bit nervous sometimes. People like they don't want to fork up all of their finances, but the truth is, if you want a home, at some point you're gonna have to be transparent about it. You're gonna have to get pre-approved before you should be getting pre-approved before you look at homes. Like, do not go look on Zillow without it.
And that's where a lot of people get uncomfortable, right? Because it's almost like going to the doctor and you have to like
strip,
take off your pants and show everything. What we do is essentially very parallel. What I mean by that is that yes, we have to take a look at your credit. We can see all your trade lines. We see all your bank accounts, we see your taxes, your income. You're pretty much showing this, but we're not here to judge, right? We're here to help you strategize on how to prepare yourself so that not only can you qualify, but how do you absolutely take advantage of getting the best terms possible, right? Which is what we like to pride ourselves why we're different. We're not just loan officers, we're consultants because we help you strategize, right?
And on top of that, it's the fact of after you get pre-approved, at least now you know your actual like price range. I don't get why people look at like 1.5 when they're only qualified, and then they're gonna end up getting qualified for 1.3, and they're like, what happened? You didn't get pre-qualified before you were looking, and it saves people. Yes, it's a little bit embarrassing sometimes for people. It's nerve-wracking, but it will save you so much more trouble down the line and so much less disappointment. At least you're not gonna go into escrow and then all of a sudden your lender says, you can't have it.
Well, that's exactly why, right? Ethan, I don't know if you had transactions, but
Thank
the
God,
number
not yet.
one
Not
reason
yet like that. Thank God.
people fall out of escrow is the lender.
Yeah.
Why do you think that is? Because, lenders, we also have, we have to make sure we're efficient. We don't want to be so detailed that we send 2-3 rounds of document requests to the client asking for this, asking for that, until they get really frustrated, right? But we have to do our due diligence. We have to make sure if they are, once they do get into escrow, can they check mark all the requirements?
It's going to be done regardless. Might as well they do it before they go.
So it is painful, but the less you do, the more you do now is the less you have to do later on.
Exactly.
Right. And I mean, that's also stemming from, how aggressive that you want to submit offers, right? At least in Southern California these days, we see escrows that come in with 21 days, with no contingencies or very short contingencies, right? So, and that gives you, honestly, the best chance of getting selected or getting accepted.
Yeah, a much cleaner offer. And you know what? It beats out even as a buyer. It beats out your chances of having competition after you. Like, whenever you call an agent, they say, "Oh, we just accepted." Every realtor is like, "I hope their loan officers suck. I hope they fall out." But it's like if you just start looking for the right people, if you're working with the right people, or you have a realtor who has a good team, that problem completely disappears.
Right.
And the name of the game is not even just like what do we do in escrow? It's now let's just get the deal in. Once we get accepted, we're good to go. Right,
exactly. And that all falls into what, let's say a better mortgage company, what the due diligence they should really be doing. The questions I often ask my clients is, or realtor referral partners, is that there's a few things that you want to make sure if you want to be hyper aggressive on an offer. If your client says, I absolutely need this property, I don't care what you have to do, I have to have this home, this is the one, right? I don't care if we should go in with no contingencies, right? No loan, no inspection, 21-day close, no matter what, right? Can the lender deliver, right? Especially because a lot of people don't see that. A lot of times the client might qualify, but a lot of things are in the gray area.
Exactly.
They won't know until an underwriter goes in and applies their decision on whether or not this is acceptable or not, right? So what we offer that's a little differently is we do what we call a pre-underwrite. So there's levels to how strong your pre-approval are. The very first is pre-qualification letter, which you see your Chase Bank, Citibank, BOA, they just issue a letter, right? It says, hey, you're pre-qualified for up to this amount, right? We looked at your credit, looked at your income, but that's just essentially a piece of paper, a letter, right? That someone looked at it. I don't know who knows each.
They did, they looked at it. They couldn't, maybe they didn't read it, but they looked at it,
But underwriters are all about details, right? They're gonna verify everything. So the next step, I would say, how you can strengthen this process and be hyper aggressive on your offer is to do what we call a pre-underwrite. So pre-underwrite means that prior to you getting into escrow, we're actually going to take the buyer's income, credit, assets, and actually have an underwriter verify this qualification.
So it's a lot more. So of those 3 stages of talking to a lender, you have pre-approval.
Right.
Which
get pre-qualification.
Yeah, and then
pre-approval means they at least ran your credit. Right. They at least looked at it a step further. And then a pre-underwrite, or what we call a verified.
Yeah, pre-underwrite, which is the heaviest thing to come in with.
Right, because we certify that underwriter has actually calculated through the mortgage underwriting process to verify that this client actually does qualify fully for a certain price point. And the benefit of doing this is that once you're in escrow, guess what? All we need to do, we already have the income, credit, and assets underwritten. All we have to do is apply the property. The appraisal, the prelim, the title reports, right? Make sure nothing wrong with the property itself. But that's also how we can cut down the time we need to process.
So you also give realtors a great loophole in order to cut down that escrow time too.
Right, which is why I can actually then turn to the realtor and say, hey, we not only have this client pre-verified or pre-underwritten, because we're so confident about this client, we don't need 30 days, let's do 21,
Yeah.
Let's do 17.
Yeah,
right?
you shave it all down.
Right.
You know, it's like playing with cash now.
Right, and no loan contingency. Why? Because we know the client's already fully pre-underwritten.
Exactly.
Right?
When it comes to you know, buyers talking to lenders, looking at loan estimates,
Right.
what do you think are the top 3 things that they should look for?
That's a great question too. So, I mean, most people have to understand this, right? What I preach is that, you know, loan estimates, no matter what, are always preliminary. That's why the estimate is in the term, right? To be honest, for loan estimates, whether it's, you know, you're shopping with a bank or an independent broker like myself, what's very true is that no matter which lender you choose, the title and escrow fees are going to remain the same.
Yeah.
Right? It's independent. What you really want to be looking out for is inside the loan estimate, there's 3 sections, A, B, and C, right? The first section A is going to be the direct charges incurred from the lender directly. And then section B is services you can shop for, right? Including like appraisal company, verification. Honestly, it says you can shop for, but the lender will choose these vendors for you.
Okay.
Right?
Yeah.
So the only difference is going to be inside of these 2 sections, right? What I really tell them to look out for is, you know, what the base lender fees are going to be, and whether or not there's points attached to it.
Yeah.
A lot of people totally forget. They think that, oh, this is a base charge that the lending company will charge everybody. But that's actually not true, right? So unfortunately, there's a lot of more less than ethical, let's say, lenders out there that will kind of play this game, right?
Yeah.
Well, they use a really low rate to kind of lure you in.
Yeah,
right?
but then there'll be like a crap ton of points attached
and they're
to
betting on you not understanding the estimate, right? So that's exactly the situation, especially in this market, you want to avoid.
Yeah.
You know, you'd be surprised. I actually saw a client send me a loan estimate to me saying, hey, how come you can't match this rate? This lender's offering me 5.25. And I was like, oh, no way, 5.25? That's a really sub-market rate.
Yeah.
Right? And I looked at it, and funny thing is the lender was charging 2.5 points buy down. Now on, you know, a $500,000 loan, 2.5 points is $12,500.
Yeah,
that
my
paying
God.
extra, which was more than her, you know, closing costs elsewhere or put together.
So in a sense, in
Right.
order for people to actually get the most for their worth, you know, let's take a recap on everything here.
Right.
In order for people to actually get the most out of their worth in terms of, you know, buying a house, they want to know you need to know the best programs out there, especially if, let's say, your finances aren't the best or your income isn't the best.
Right.
You know, or you feel like you're in a position where it's like, oh, I'm trapped. I'm never gonna get out of this LA market. You know,
Right,
you know,
right.
you always gotta know. You know,
Yeah.
there's different resources. There's different programs for you. On top of that, don't always just look at the rate.
Right.
The rates
Take
are
the rate.
attached to
Right.
points. The rates are attached to, you know, your overall payments. Sometimes even the rate isn't even worth fighting for. Sometimes.
Exactly. So that's why, you know, I preach that it's really dependent on every person's situation, right? Someone that, you know, barely has enough for closing costs, where it's kind of stretched thin, right? Why would they pay points to save a couple $100 per month on their mortgage,
Yeah, exactly.
right? Or, you know, likewise, right now, we know rates are going down. And likelihood of someone refinancing, I think there's a statistic that said home buyers on average will refinance within a 5-year period. Almost 90% of home buyers will refinance before that 5-year mark.
Wow.
Right. So, yeah, we're here to really help. I help so many clients really capitalize when the timing is right. You can't time the purchase. You can't time when the perfect home shows up in the market.
Yeah.
You can't time. You know, telling the seller, hey, I need to wait a little bit for a couple months. I know the rate's going to drop, right?
Yeah.
They're not going to wait for you. So I tell people, don't be so infatuated or so stressed out about where the current rate is, right? No one can control where the rates are, where the ranges are. But what we can control is timing your refinance. When that is
100%.
appropriate, you know, once rates really do drop, right? Then you can capitalize, right?
Yeah.
But the most important part is getting the property when you're doing a purchase.
Yeah,
right?
and that's another problem that I see with a lot of first-time home buyers too, is it tends to get emotional, very much more emotional than it does, like logistical.
Right.
And they're always looking for that big nice house, They're looking for that final house, I'm going to settle in on this house.
Right.
But truth of the matter is, the more you wait, the more different things will change. You're waiting for the rates to drop, but let's say sooner down the line, if let's say your income doesn't match the kind of house that you want, you're gonna end up realizing that you should have just bought a house in the first time.
Yep.
Use it, build that equity, use it to trade for that much bigger house later on. Most of those big houses that people live in, those were never those people's first houses. Those are like their fifth, sixth, sometimes even 10th.
Exactly. So, like I said, opportunity cost is huge, and people don't realize that same home, even if you just wait 1 year, if you add appreciation and you add the factor of more buyers coming into the market once rates drop, that same home could end up costing you $150,000, $200,000 more in a year.
Exactly.
Right? So I tell people, you don't need to connect all the dots. It's almost like, finding the one in your life.
Yeah,
right?
You'll never know unless you just, put in the offer and
There's
find out.
not going to be the property that has the best terms at the best time with all the features you want. Right?
Yeah, because chances are if you want it, other people are going to want it too.
Right.
And then you're going to end up having to pay more, the negotiation process is going to be crazy too. Who cares about the rate, dude? You're going to end up having to pay more regardless out of pocket.
Right, and I can't express how many, I have two buyer pools, right, that I work with, and I can't tell you about, I've had some clients who have been sitting on the sidelines for over a year and a half, almost 2 years, right, because they are the type that are perfectionists, right?
Yeah.
They want to make sure the stars aligned and it is the one.
They're never going to buy a house.
Right, that same property I actually just checked recently, they originally offered, they were in escrow for $1,050,000, right? And I checked on the, what the price is sitting at right now, it's already at almost 1.3 million. Right, and they backed out of that escrow because they were worried that it was not the right home, right? And now they're still renting, and they missed out on $200,000, $300,000 worth of appreciation. Because guess what? If you are truly unhappy with that home, just sell it later on, and then you get an extra free down payment for your next home.
I'm so glad you mentioned that, because another thing that I feel like people feel. It's kind of one of those things that's ingrained into your head, right? I feel like it's because we go through shopping so many times, and it's like you can't return strawberries, right? But homes are different, you don't like it, you can sell it, and especially where we live in LA, this area. The chances are you'll probably make a little bit out of it. You'll make a good amount out of it. If
not, you don't have to pay buyer's commission.
Exactly, and you don't have to pay buyer's commission now. And chances are, even if you do come out at a loss, it's not going to be as detrimental to you as you think it is. Like compared to what you just bought, it's nothing.
Right, and people don't understand. There's also so many tax benefits. You get primary home interest, mortgage interest deduction benefits. You can file expenses. It's just so beneficial on so many levels, right? That people don't really think about, right, long term. So
I think we pretty much went through everything. I don't know. Is there anything else that you want to cover over?
I mean, in terms of your experience, I know some agents have, let's say they're very aggressive with their clients, right? What is your take on, let's say, because a lot of times I'm in a situation where I tell the realtor the truth, right? Which is, hey, this client is potentially qualified. We got to work on loan structure. But, based on what I see, they are pre-approved. And as soon as I give out that letter, the offer goes out, right? And it goes out with, 10-day loan contingency, and hyper aggressive. And they tell me, hey, because I'm like, hey, I'm a little concerned because I try to raise like, hey, there might be a little,
discrepancy.
Right, or part that may cause issues with approval, right? But they're just like, you know what, let's just rely on the 10-day inspection. If it really goes south, let's just back out, right?
Like, what would I do in that situation? Well, as me, as a realtor, I like to be honest with people. I feel like, although many people can be dishonest and make good money out of it, that's just not who I am. I'd rather not play with the idea that those people can call me back anytime. But it's like you said, if you were to tell me that there is a discrepancy, I would let them know, like, hey, this is a problem. This can be a thing. As a realtor, I'll tell you, get it fixed. but you as the buyer are the person who makes the decision whether the offer is going to go out or not. You know, it's I would recommend to them, yes, get it fixed. But if you really just could care less about it, I just want you to know I told you not to. You know, or I didn't tell you not to. Kelly told you not to.
Of course.
You're mad at me. You go to Kelly.
Course. Always play the loan officer. That's the name of the game. Right?
It's because you know, again, you know, for us, at least as a realtor, what we firmly believe in is the same thing. Perfect one is never going to come until like later on, and even then, you at least want something to work with. You want that experience. You know, you don't ever want to waste. You don't ever want to have that awkward first kiss moment with the perfect girl, right?
Right.
And it's you want to have a little bit of experience. You want to have that equity. You want something to trade with. Just get it done.
Right.
And if it will make you so much more powerful, give you so much more equity to work with, and a lot of people never take that into account.
Right.
Because it's all just plain level thinking. You know, it's if they feel like they can't afford it, immediately they're going to be like, I'm never buying a house, renter for life, goodbye.
Exactly. So don't be one of those guys, you know?
Yeah.
Listen to your realtor.
Listen to your realtor and your loan officer.
Yeah,
all right, well, I appreciate you for coming out. I think we've gone through everything.
All right.
If people ever have any questions, can they reach out to you?
Yes, anytime.
100%.
I don't know if you want to link.
I'll put everything down.
Yeah.
If they ever want to reach out, you know, all of the details will be on our YouTube. You can check it on, you know, down below. There'll be a little like pop up right here that says, you know, call us here, text us here.
Yeah, anytime. Text me, call me, email me.
Yeah, 100%. And we'd be more than happy to help you out, especially if, you know, you're in that position where you do want to buy a house. You feel like, damn, this LA market is going to trap me. You know, I might have to live in an apartment my entire life. No, that's not the case.
Right.
It's usually not. If it was the case, we would have been out of jobs. You know, but we're not. So we know that there's loopholes for you. It's especially in a growing market like this.
Right.
Now more than ever, is it more important for a buyer to know their resources? Because now, truth be honest, it is harder to buy a house.
It literally is make or break, right? With the right, you know, loan officer, they could have structured something that could have worked for you, rather than you thinking, oh, there's no way I can get approved, right?
100%.
So
thank you guys again for tuning in, listening, or watching wherever you are. Once again, my name is Ethan.
I'm Kelly.
And this was the Realtor Roast, the podcast where we break down real estate myths and brew up smart strategies. And we'll see you guys next time.
See ya.
Bye.